Hi, and welcome back to our Preparing for Retirement podcast. I'm your host, Mark Cram, Certified Financial Planner with Cram Investment Group in Durham, North Carolina. And today we're going to be studying some case studies of a private retirement plan. So what we're going to find out is, what does it take to create a plan? What can I do with my plan? And how much income could I expect from my plan? So let's get started. Our first case study is a male age 45. He has $500 a month that he could put away for his retirement. And of course, he's concerned about his own retirement, as we all should be. This is a copy of the illustration from the Life of the Southwest product called Paragon. What you can see is that we have set this up so that the level premium will be a little over $6,000 per year, which is equal to $500 per month. We've set it up with $100,000 of base insurance and $265,000 of term rider. The term insurance will actually make this product be much more effective as a cash accumulation vehicle. What you can see is that we're using a rate of 8.9%, which is actually the S&P 500's average return over the last 57 years for this product. You can see that in 10 years we've accumulated $60,000 and it has grown to $71,000. This money in this current cash value column is cash available to you. So if you needed, you could in year 8 here, for instance, borrow money out of this product to buy a new car, make a down payment on another piece of property, or any other use for this money that you would see fit. This, in essence, becomes your private bank. As we go out into his retirement, and we're showing retirement at age 70 here, this column is the income from our loans. And you can see we're starting at an income of $37,543. Now, this is tax-free income. So this would be equivalent to probably over $50,000, maybe even over $60,000, depending on your income tax bracket. You can see the cash value in the policy here and the death benefit here. As we borrow money out, the cash value and the death benefit will both decrease until you reach a point where the growth of the loans, because we're using variable rate loans here, actually becomes enough that this product actually starts growing back in value. What we can see is that we've saved $150,000 over the 25 years that this person has put this money away. As we take this income out, if he lives to age 99, we've taken out $1.6 million out of this product, and we're dying and leaving a death benefit of $382,000 to our heirs. In our second case study, I've got a male age 65, but in this case, he has $100,000 in assets. This could have come from equity in his home, from an inheritance, or from some other source. And again, same scenario, he's concerned about retirement. Now, in this particular case, we're using the exact same product, but here we're going to need more death benefit to hold this amount of money. So, holding $100,000 in one fell swoop, that is over a 5-year period of time here, I'm using $150,000 of base policy and $400,000 of term rider. Here, I'm concerned about this modified endowment contract limit. So here, because I want to put this money in as fast as I can, I want to stay just below that. So I'm putting in $25,111. It's going to take me 4 years to get the money in. And the last year, I dump in just a little bit more into this policy. Now you can see that in the 5-year time frame it took me to put this money in, and I'm using the same 8.9%. It's now grown to $116,000. Because I've got more money in quicker, you can see that the cash inside of my private bank here is actually more. So I have a lot more ability to borrow money and use it for various purposes that I might need during my lifetime. Here again, we're going to start with a retirement plan of around $53,700 at age 70. And we're using a 3% cost of living allowance here, so we can see that this income increases over time. And in fact, in this case, because I put this money in a very short period of time, I put in less money, $102,000. I've got out more money than if I put that money in over that 25-year period of time. So I've taken out $2.4 million. I'm going to leave my heirs with over $500,000 at age 100. My last case study is a male age 55. In this case, we're looking at somebody who has a home that's paid for worth $350,000, and they have $400,000 in an IRA earning 6% interest. They also want to retire. In this case, they want to retire at age 65. So what do we have? Well, we have a home worth $350,000. What we're going to do is we're going to take out an 80% loan on that home, $280,000. We're going to take that money and we're going to put it into the life insurance product. Now, it will take us 5 years to put it in, but we're going to let it grow for 20 years. Now here I'm using an 8% return, which is equivalent to the numbers I've been using throughout my podcast here, and some of you may have been wondering where you can get 8%. Well, we've seen that these products can earn upwards of 9%. So I'm just using 8%, and I'm going to let this money grow for 20 years. We also have an IRA here, which is worth $400,000. If we can let it grow at just 6% interest over the next 10 years and not put any more money in, this IRA will grow to be worth $700,000 at age 65. Now, our home is also going to continue to grow in value. So over the next 10 years, it's going to increase. If it increased just at 5%, that home will be worth $576,000. At age 65, what do? Well, let's start pulling money out of that IRA account. Remember earlier in these podcasts, I mentioned that it's a good idea to get this IRA money out early if in fact you think taxes are going to be going up. So let's use this first. Now, if it continues to grow at 6%, I can pull out $85,000 a year and the money will be depleted in 10 years. Now, I'm going to have to pay taxes on this money, but my net income is going to be about $56,000 after taxes, assuming about a 30% tax rate. Now again, my house is going to continue to grow in value, so by the time I get to age 75, my home's going to be worth almost $1 million. Now at age 75, my IRA is depleted, and now I'm going to start taking money out of my Equity Index Universal Life Insurance Plan. Here, if I live for another 25 years or until age 100, I can pull out $95,000 per year tax-free for the next 25 years. That's over $2.2 million. Again, my house is going to continue to grow in value, and in fact will be worth over $3 million by the time I reach age 100. Here you can see again, we're looking at this modified endowment contract limit, and we're going to stay just below that, and it's going to take us 5 years to put this money in. I'm actually putting in a little bit less than $280, and I'm growing it at 8%. So by the time the money goes in, you can see again that I have quite a bit of money accumulated in this account, and this money is liquid money that I can use for various purposes throughout life. I can use it to buy cars, I can use it to educate my children. Again, ultimately I'm using it for my retirement planning. So if I'm going to do that, I certainly would want to pay it back if I used it as a private bank. At age 75, I'm taking out $95,000 per year for a total of over $2.2 million. I die and leave a small amount of money to my heirs, but of course, I've also got a home worth $3.3 million. So what have we accomplished by doing this? Well, the first thing we've done is we've provided safety. In most states, money inside of a life insurance contract is free from creditors and free from loss. But I've also created liquidity. I have access to virtually 100% of my money while this money is being accumulated. And of course, I'm accessing that tax-free. I've increased my retirement income. I tell people that we can increase their retirement income by 50%. In this case, we've almost doubled our retirement income from $56,000 after tax on our IRA money to $95,000 tax-free from the money from our life insurance policy. And ultimately, of course, we've got choice and control. We decide how and when to use our money. So, what we've done here in creating our private retirement plan is we've shown you how you can have predictable returns, how you can have liquidity with the money that you've put aside, and how you can take advantage of tax-free growth and tax-free income to create a truly free retirement plan. If you want more free information from us, Please don't hesitate to contact us, or certainly check out our website, www.equitymaximization.com. And I'll look forward to seeing you next time as we conclude this podcast series with an overview of what we've done to this point.